Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Paul Curcio, managing editor of ETF.com. Joining me today is ETF.com's superb team of writers and editors, senior ETF analyst Sumit Roy, senior content editor Kent Thune, and contributing editor Ron Day. Welcome all. It's been a big news week this week, and mostly the news has been about the economy and the wild ride markets have been on the past 100 days since President Trump took office. Key indicators have been flashing red all week. For instance, this week's manufacturing index from the Dallas Fed, the consumer confidence data, JOLTS and ADP jobs data, CPE, and the big daddy of them all, first quarter GDP. Yet, the major indexes have been on the upswing for the past 5 days. Sumit, you wrote this week that equities ETFs fared really well following the disappointing GDP report. So, is bad news good news again for investors?
Yeah, I mean, it's a good question, Paul. I don't think bad news is necessarily good news for investors. I think it's more a case that we haven't really had the type of bad news that investors have been fearing, right? We've been getting a lot of bad news in the soft data, the sentiment surveys, and things like that. But the hard data has held up reasonably well. You mentioned the GDP report, of course, is a shocking number, negative 0.3% annualized growth in the first quarter. But if you look at the details within the report, it wasn't that bad. That number was mostly due to a surge in imports as companies try to get ahead of the tariffs. But consumer spending was relatively strong, business investment was relatively strong. So I think that's why the market has been so resilient. Thus far, there's been a lot of fear, but we haven't seen that weaken the economy dramatically, at least yet. And of course, everyone is holding on to that hope that Trump eventually reverses course on tariffs, he strikes deals and things like that. And I think that's the reason that markets have rallied. But it has been so surprising, this rally. It's caught so many people off guard because you hear about all these tremendously negative headlines, right? Everyone's so pessimistic. We're hearing reports about shipping volume dropping off a cliff. Yet here, the S&P 500 has rallied so much where it's completely erased all of the losses that came after Trump's Liberation Day tariff announcement. I'm looking at the S&P 500 right now. We're recording this midday on Thursday, and the S&P 500 is only down 3.5% year to date, which is practically, not nothing, but it's significantly improved from what we saw after the Liberation Day announcement. At the worst point, S&P 500 was down 18.9% off its all-time high. Right now, it's only down 8% off its all-time high. So I think this is actually a cautionary tale, right? You want to stick with your long-term investment plan. Don't let all the pessimism, all the headlines throw you off that plan because you never know. The market tends to rally when you least expect it.
So, Kent, you wrote about the old Wall Street adage that investors should sell in May and go away. People have been saying this on Wall Street for years. So today is May 1st. Considering what Sumit just laid out for us about how the markets made this tremendous recovery in a very short period of time after Liberation Day, does that advice still hold in today's turbulent market? Can an ETF investor just set it and forget it until October without losing sleep?
Sure. Well, I mean, the first two words are usually in response to a question like that. It depends whether or not you can sleep. I mean, if you're a long-term investor, by definition, then your holding period is probably 10 years or more. You can sleep like a baby, just putting your money in, S&P 500 index funds, and if you're more conservative, you can mix in some core bond ETFs as well. But in terms of the year, I mean, the history does show, you can go back all the way 100 years back. A lot of the studies that I was looking at went back to 1950, and the returns are better from, say, November 1st through April 30th, much better than they are from May 1st through the end of October. Now that's seasonality. So what that means is that, typically you're going to have some down periods. Also, what skews that is October. October, there's been some really terrible stock market performances in October in history, so that skews it. But to answer your question even better, I was directing the article toward advisors, but also investors. And you don't want to ignore seasonality, but you don't want to just play your whole portfolio around it. Now we're looking at these macro data and Trump tariffs and things like that. So we're looking forward. Is it a good time to hey, it's all clear. I'm putting all my money in the S&P 500, VOO or SPY or one of those. I don't think so. It's a good time to be diversified. You should always be diversified. I'm kind of all over the map here, but this year is actually a good demonstration of why diversification is important. I mean, we have international stock ETFs up. We have bonds are positive. Gold is through the roof. So yeah, in my article, and you can see it on our website, I'm talking about just some tactical moves where you want to protect your portfolio. But I think it's foolish to just jump out of the market in the sell of May and go away in an absolute sense, but more like diversify and kind of tweak some things.
Yeah, great point, Ken. This really is a year that highlights how diversification across asset classes can really benefit your portfolio. International stocks, gold, even crypto like Bitcoin, if you're interested in that. It's really helped this year as US stocks have underperformed pretty much everything else that's out there.
And Ken, you wrote about the PCE report earlier this week, and you threw out some ideas for some sectors that investors might want to look at in case of a negative print. What did you find that you thought was helpful?
I was really capturing all the macro data coming out this week: GDP, PCE, inflation, as well as consumer sentiment. If you don't mind, I'm going to talk a little bit more about consumer sentiment, just because.
Sure.
In my mind, of course, all this macro data is looking backward. What happened over the last month, but to me, consumer sentiment is more of a forward looking, because if consumers are not feeling confident, if they're feeling just like business owners, if there's uncertainty, then you're not going to invest. You're not going to buy stocks. You're not going to buy say even big purchases. You may put off buying a house, you may put off buying appliances, although I will give a little caveat there. There are people that are buying, cars and appliances just because they think the prices are going to go up. But my point is that this macro data points out that things are slowing down. And that's because of the uncertainty amid the tariff policies. And so this to me underscores being more defensive. I mean, consumer activity is almost 70% of the US economy. So if consumers slow down their spending, then that doesn't bode very well for the economy overall, or the stock market, or the ETFs that we're talking about, especially the broad market ETFs.
And there's still one more to go. So as Sumit mentioned earlier, we're recording this on Thursday about midday. Tomorrow morning is the jobs report. So if we're going to look at that based on the ADP numbers and JOLTS being disappointing already this week, what are we looking at ETF wise if we see another disappointing report and it's pointing towards bad employment figures? What ETFs are we using for a little protection?
The market moves on surprises, right? If there's a surprise to the upside or the downside or whatever, if everything comes in as expected, we're not going to see much movement anywhere. But I think you're talking about a surprise where the jobless claims or the job market looks weaker than is forecast. Then the first thing I think of is Treasury yields fall, which means that bond ETF prices rise. They have an inverse relationship. So then you might be looking at some of those longer duration ETFs, like the iShares 20-year plus Treasury ETF, TLT, those prices could go up. I don't know if investors are a little bit wary of that too, because of the volatility there. So we probably would still see more of the uncertainty type plays, like the ultra short-term bond ETFs, SGOV. Gold could come in back into play. I mean, a poor jobs report just kind of means just confirms that the economy is slowing down.
On the flip side, though,
Right.
Sumit was looking very optimistically at the data. What if this morning's data for jobs is actually meets or exceeds expectations? Sumit, how would you see that ETF wise?
Yeah, I think that would support the current narrative that we're seeing in the market. The stock market has been moving up on this idea that the US economy is going to remain resilient. And it's been right about that for the most part. We have seen generally the economy remain pretty strong. Of course, there's so much uncertainty out there, but I mean, I think that's been the story of the past, not just this year, but the past 3, 4, 5 years. We go back to 2022. The Fed raised interest rates from 0 to 5%. Everyone thought the jobs market would buckle, the US economy would buckle, but it absorbed this massive spike in interest rates pretty well. And it just goes to show just how resilient the US economy has been in recent years, and it's been extraordinary. And I think if we get a strong jobs report on Friday, it's just going to reinforce this idea that the US economy can absorb so many blows and still remain so strong. So I think right now I'm looking at the estimates 125,000 jobs are expected to have been created in the month of April. I don't know what's going to happen there. We're probably going to get a number that's positive, I would think, given everything else we've seen in the hard data. But regardless, I mean, I just keep going back to this point. It's just extraordinary how well the US economy is holding up still and how well the US stock market is holding up because the stock market is forward looking, right? So it's looking out 6, 12 months, whatever the case may be. And we're getting all this negativity surrounding, eventually the economy is going to fall off the cliff because of all this trade war stuff. But the stock market doesn't seem to be reflecting that. We're only down 3.5% year to date. So what is the market thinking? Is it thinking that all this trade war stuff is going to be dialed back dramatically? Or does it think it's going to remain in place, yet the economy somehow is going to absorb it and remain strong, even in the face of high tariffs? I don't know. Anyone can really interpret it how they want, but it's going to be really interesting to see where we are 3, 4, 5 months from now after all this kind of shakes out. Is the stock market correct to be so optimistic? We'll find out.
Hey, Samit, is it possible that for all of the doom and gloom on the headlines we read and that kind of thing, that fund managers and investors and money people are behind Donald Trump? That I mean, is it an army of Howard Lutnicks and Navarros? And I wonder if that might be the case. I mean, there are, the hardcore capitalists who are saying this is gonna,
I think
we're buying it.
I think ultimately, Ron, investors, they are pretty singularly focused on one thing, and that's corporate profits, right? If they think something's going to be good for corporate profits, that's generally supportive of stocks. If they think it's going to be bad for corporate profits, it's negative for stocks. So I don't think investors are, as a class, are very political, and necessarily they're more all about the dollars and cents. But you do bring up an interesting point because I've been seeing headlines and news reports recently that retail investors in particular were big buyers of stocks during the month of April, even as institutional investors kind of pulled back from the market. So there might be that dynamic.
Buying the dip.
Yeah, buying the dip, right? So certain investors might be a little more bullish than others, and maybe retail has been accustomed to buying the dip and they've been coming in while institutions are more worried. Who knows, right? We're all kind of guessing based on different data points. We can't really, exactly know who's buying what and when. But
there's also the company buybacks too. I mean, that helps keep the market going as well.
Yeah, we have a lot of very secularly strong forces that are underpinning the market. The buybacks being one, index fund flows being another. There's billions of dollars entering the market every day from people plowing money into their retirement accounts.
If you had to pick one ETF, guys, that represents what this market looks like, what would it be?
I can start and pick I don't know if I'm getting ahead of myself too much, but the top ETFs that performed, or the top performing ETFs during Trump's first 100 days. Number one, volatility. I mean, it's a volatility ETF. So one thing that's to me that is certain is that we're going to have more uncertainty. And so if I know volatility ETFs are not long-term investments, but I wouldn't be surprised if they're one of the best performers over the next 100 days.
One I'll choose is a VXUS, which is the Vanguard's international stock ETF. It's up 9% this year, which compares to, as of right now, the S&P 500 down 3.5%. We've talked a lot about the outperformance of international stocks this year. This is a great ETF that captures that trend, and it'll be interesting to see whether that outperformance continues throughout the rest of the year.
Ron, what's your pick?
I'm just saying, you can look where the bets are being made, and the bets are still going into the big S&P 500. Billions going into them. Even if they have slid, there's still a lot of doubling down going on.
So, VOO, VOO.
Oh, what a good segue!
What a nice segue.
Yeah, how
convenient. That's
yes.
right. That's where I would go with it. Yeah, totally. So yesterday, Ron, you wrote a great feature story marking the 50th anniversary of Vanguard's creation. And you focus on how it's not just about the history of the company, but its impact on investing. So what's Vanguard and its founder, John Bogle's legacy?
You maybe just kind of chalk it up to culture. He kind of created a culture. And I don't think it's like a cult as much as a culture. So because, I don't think these are people who are just kind of transfixed by John Bogle's wisdom. I mean, the guy made a lot of sense, right? I mean, and he seemed to have lived his ideas. Vanguard, I think, brought in like 27% or owns 27% of the ETF assets. At the same time, they bring in only 5% of the revenue, which is a testimony to their fee structure. The fees are so low. John Bogle, the guy created, helped make a lot of people really wealthy. He died with an $80 million fortune. Now, we could do a lot with $80 million. You compare him to Ken Griffin or Warren Buffett or something like that. I mean, he really just pulled out a tiny amount of money for himself. So, he definitely created a culture. It seems like he created kind of a connectivity between his company and the investors in the company. I mean, there are 100,000 Bogleheads, right? So, and one anecdote I think that kind of works for me is that when people ask me, like people, they hear, "Oh, you work in the financial press. What should I do with my money?" Which of course I'm no expert, but I just say, go to Vanguard. I had a family member who.
I thought you were going to say go to Vegas.
Yeah, go to Vegas. That's one thing to do. But if somebody says, "Oh, what I just got whatever a little inheritance," I say just open a Vanguard account. This is the first thing to me, and I would assume I'm not the only person who gives that advice.
Well, Buffett gives that as advice himself. He's famous for saying, when I die, these are things I suggest that my beneficiaries invest in, Vanguard index funds.
Yeah. I mean, it's really quite a culture that has been built, and I don't think you would have gotten the culture if with high fees. I mean, it's all about just cutting costs, and kind of taking some of the mystery out of just investing your own money. Now, Vanguard was helped by the rise of the internet. And kind of like, I guess, the dissolution or the 401ks became really popular as Vanguard was launched, right? We went from pensions to 401ks, and man, they just rode that wave. And I don't know if it was, I would assume there was some intentionality to that whole thing. So yeah, it's been it's been some really fortunate, circumstances with the company, which, they clearly made their own luck. So
they clearly did, but it's more than just luck. I mean, VOO or VOO hasn't become the biggest ETF just by accident, right?
Correct. Yeah.
But it also, and we've been tracking it, for months now. Its rise to the top, overtaking SPY. But it does have stiff competition. So real quick,
Yeah.
what is that competition, and do you think VU will remain resilient and fend off all
Well,
comers?
well, it's funny. Another piece that I had written last week was about how Vanguard is, and with the help of Kent, Vanguard has the edge in ETF flows, right? Vanguard's the second largest, BlackRock's the biggest. Vanguard is bringing in assets just a little faster than BlackRock. I mean, this year that Vanguard is just crushing them, but on a an overall basis, it's kind of an incremental gain. But there is speculation that maybe in a decade, Vanguard will be the world's biggest ETF issuer, the world's biggest asset management company. So, I guess it's all about the fees. They're two different companies culturally, right? BlackRock and Vanguard. And I'm guessing there are more, like our story said, bringing investing to moms and pops for a generation. I think there's probably a larger base there, or very big base of that kind of money. So,
All right. Well, finally, I would like to do something a little different to finish off. Let's play a new game, right? We've already played Flirt, Marry, Kill a couple of times. Here's something our intrepid social media reporter, Joy she came up with, and it's a little gem she calls What the Fund, or WTF for short. I'll throw out a few facts about an ETF, and see if you guys can guess the ticker in the fewest numbers of tries. All right, so here we go. I'm going to give you an easy one first. All right, just to get you warmed up. So good luck. All right. People often use the phrase blank and chill to describe this ETF. It recently took the top.
VOO.
There you go.
VOO.
It recently took the top spot for top ETF. Yes, VOO. Speak of the devil, right? Easy one. Can't miss with that one. All right, here we go. Let's try another one. This ETF is up almost 90% since it debuted in
I bet.
whoa!
I just did a
Wow.
story on this the other day, and I was looking at the literally the return since inception just the other day, so it matches that.
This is Family Feud, man. This is like,
Oh, I gotta get a buzzer for this. This is awesome. Yes, and it's one of the fastest growing ETFs of all time, gaining up to 10 billion in the last couple of months, and it tracks the cryptocurrency Bitcoin. All right, last one. This is a leveraged ETF that grew 350% in 2024.
Sounds like could be it.
Could be it. All right, let's see. It saw 3.4 billion in inflows last year, and it tracks one of the Mag 7 stocks.
Sounds like NVDL.
Yep, NVDL. Boy, Sumit, I'm gonna have to make these questions tougher next time.
Should give a prize next time, Paul.
Yeah, I will give a prize. You'll get every Sunday off.
Oh yeah.
All right.
Nothing better than that.
All right. Quick parting shot. Federal Open Market Committee meets next week. Cut or no cut? Ron.
no cut.
Sumit.
No cut.
Kent.
No cut. Fed funds futures say something like 98% chance they're gonna pause. So I'm gonna go with that.
I say no chance Powell's going to cut. So it's a shutout. No cut next week. All right. That's it for this week. I'd like to thank all of our listeners for this week's edition of Exchange Traded Fridays. And thank you for streaming or downloading today's episode. Remember, if you haven't already, please like, subscribe, or follow us wherever you get your podcasts, whether that's Apple Music, Google Play, or Spotify, or someplace I may not have mentioned. If you have a question or just want to share your thoughts, join the conversation with us on X, formerly known as Twitter, and our handle there is @ETFCOM. See you next Friday.